Palantir is down hard. The business looks strong. But the chart says, don't touch it.
That is exactly when opportunity starts.
Or exactly how investors get trapped.
So today, the committee has one job: decide whether Palantir is a dip or a trap. Welcome to Model and Market. I'm Emma. Let's find out.
Let's start with the business. Palantir is not a broken company. Revenue growth is strong, cash flow is powerful, and AIP is becoming a serious enterprise AI platform. If this sell-off is mostly sentiment, then the market may be offering a rare entry point.
But that is the dangerous assumption. The stock is not falling because the business is dying. It is falling because the valuation left no room for disappointment. A great company can still be a terrible stock when expectations are too high.
That is the core conflict. Rupert sees a high-quality AI compounder. Daniel sees a stock that was priced for perfection. And for the portfolio, the question is not whether Palantir is interesting. The question is whether it is investable right now.
The fundamentals are hard to ignore. Palantir has exceptional margins, strong free cash flow, and a fortress balance sheet. This is not a company burning cash and hoping for the future. It is already profitable, already scaled, and already benefiting from AI demand.
And yet the market is selling it aggressively. Price is below the short-term, medium-term, and long-term moving averages. Momentum is still negative. Volume has been heavy on down days. That does not look like quiet accumulation. It looks like distribution.
Or capitulation. When strong companies fall this hard, fear can go too far. The RSI is oversold. The stock is near the lower Bollinger Band. If buyers step in, even a simple rebound toward the 50-day moving average could be a meaningful move.
Oversold is not the same as undervalued. That is the trap. A stock can fall 30%, still be expensive, and still fall another 30%. If the trend is broken, buying just because the chart looks stretched can be very costly.
So Rupert is arguing for asymmetric upside. Daniel is warning about the oversold trap. Let's make this practical. If Palantir is already in the portfolio, should we sell, hold, or add?
I would not sell a company like this just because the market is scared. Palantir has government contracts, commercial expansion, AI adoption, and strong cash generation. If the long-term thesis is intact, selling into panic could be the wrong move.
I agree, we do not need to panic sell, but we absolutely should not average down blindly. This is still a high beta stock with a premium valuation. If the stock breaks the recent low on heavy volume, the downside can accelerate quickly.
That is why I would use levels, not emotions. Keep the position alive, but only add if the stock proves itself. A close above the 50-day moving average, around $137, would show the market is starting to repair.
And if it cannot hold the recent low, around $107, then the thesis changes, not because the company suddenly becomes bad, but because portfolio risk comes first. A broken stock can damage returns even when the business is impressive.
This is the difference between conviction and discipline. Conviction says Palantir may be a long-term winner. Discipline says we do not have to buy every dip. The committee is not here to admire the story. It is here to protect the portfolio.
But we should not ignore the opportunity either. If Palantir keeps growing at this pace, today's price could look cheap years from now. The best companies rarely feel comfortable to buy when the opportunity is greatest.
True. But the best investors also know that price matters. At extreme multiples, the company has to keep delivering almost perfectly. If growth slows, margins compress, or international contract risk increases, the valuation can reset fast.
So the committee is split but not confused. Rupert wants to preserve upside optionality. Daniel wants strict risk control. And both arguments lead to the same portfolio answer. The committee's decision is hold. But this is not a passive hold. This is a disciplined hold. Here is the plan. If Palantir closes above the 50-day moving average, around $137 on strong volume, the committee would consider adding. That would show a possible trend repair.
And if the fundamentals stay strong, we stay patient. Strong free cash flow, strong growth, and durable AI demand keep the long-term case alive.
However, if revenue growth slows sharply or free cash flow margin compresses, then the premium valuation becomes much harder to defend.
So is Palantir a dip or a trap? Right now, it is both. The business is good enough to watch closely. The chart is weak enough to avoid buying blindly.
Opportunity is there.
But the risk is real.
And that is why the model refuses to chase the dip. This is Model and Market. We do not buy stories. we buy setups. See you next time.